You've relaunched your bridging product range with new features and risk appetite. What are, in your words, the key USPs, and why did you decide to bring this refreshed offering to market?
Sure. So the key driver behind our relaunched product range is really better defined product categorization. What that enables us to do, or will enable us to do now, is better tailor the pricing, the loan to values, and the features we're able to offer to reflect the different facility types and the different risks that are associated with it. The feedback we always get, rightly so, is give us maximum clarity. This is from brokers and from the broker market. And so what we're trying to do is provide as much clarity on appetite and criteria and pricing as we possibly can. I know that's been one of the muddled messages of this year, which has been everyone on the surface saying we're open for business, but no one really knowing what that means. And so our new range splits our residential offering into different product types. So we've got development exits and development finishing exits. We've got refurbishment bridges, and that's alongside what would be the more typical and traditional bridges around purchase bridge or a rebridge. And if we take a step back, because it's been quite a year, thinking back to January, February time, there was actually a pretty significant move in the specialist market right at the start of the year in terms of, I guess, pricing pressure and also competition. And then clearly March came and COVID hit, and lenders pulled out of the market or tightened criteria pretty much across the whole spectrum of products. And then clearly Siebels came along, and for us at Ultimate Finance, Siebels has really taken up a lot of our attention, and that's across all of our products as well as bridging. But this is, I think, I've said this before, but I do believe now this is coming to an end, and so it's very important that we come back to market with a revamped offer, and that's really what this is all about this week. I mean, from our side in March, what we did was we tightened our criteria, we reduced our maximum loan to values, and we focused just on the residential space pretty much. But in doing so, it made us realise we were losing a little bit of what made our offer so strong previously. And so we've taken a lot of soundings from the market, from our broker partners, and designed this relaunched product range with that feedback in mind, but also to reflect our view, and we had to take a view on this, on economic conditions and where the market is generally. And as you mentioned, the key feature that we're including within our finish and exit and our refurbishment products is an equity release offering. So where we lend on day one against current value, where there'll be some finishing works, what we'll be able to do now is essentially refinance a portion of the completion cost that would be incurred by the client, and we'll provide the capital for them to release some equity from the project and essentially move that liquidity onto the next project. So this would be capital that would otherwise be tied up for the duration of the term. So we do think there'll be good demand for this. We think that it's solving a problem that is in the market, and there isn't too many other people that offer something similar. So really, that's everything. Our relaunch is just trying to maximise our clarity in the market, and a key part of that, which we know, but we keep having to remind ourselves, is that part of defining and providing clarity is actually articulating what we won't do, and that, as much as anything, has dictated some of our features and our offering.
How have you been able to get comfortable with increasing your maximum LTV to 75% when others are still on, they're still reduced?
So it's been in dialogue with our valuers, so talking to the valuers about how they're seeing the market, but also understanding what's actually going on the ground. So clearly there's a big downside risk from economic conditions on the housing market. Typically you'd see higher unemployment and recessionary environment would lead to transaction volumes reducing and potentially pricing reducing. Clearly there's been some structural drivers of change this year in the housing market, which has actually gone the opposite way, partly through stimulus, stamp duty holiday, but I think we now have a much better understanding of where is the market heading in terms of different types of product, different types of property, whether that's the semi-detached, detached housing market versus new build apartments, which may be slightly more exposed to what's going on in the urban market. And so we're now comfortable that going back to 75% enables us to be true to who we were and who we are in the specialist market.
Thanks for that. And what is your outlook for the bridging finance landscape in terms of competition offering, supply and demand next year?
So outlook is an interesting one. It's sometimes been hard this year to look beyond the next 6 weeks, let alone 6 months. But I mean, fundamentally, bridging is and will remain a very significant part of the property financing market. It's a vital source of short-term capital, and particularly when other products are harder to come by, whether that's commercial mortgages, development finance, typical finance products that are out there, where as they stay constrained to some degree, bridging can step up and will step up, I believe. It's all about speed with bridging. Everyone says the same things, but it really is, and it comes down to what the product and what the capital enables, and liquidity is everything. Cash is king, as they say, and I mean, I've got a firm belief that liquidity will allow the right investors to capitalize on opportunities that others won't be able to, and one of the fundamental ways that they'll be able to do that is through bridging. So I do think in terms of demand for the product, it's going to be very strong, and I think for the specialists in the market, I think it could be a particularly strong year. In terms of supply, I think it depends on how wholesale financing markets react, because, and we've seen it in our book, redemptions have been slower. We had a very immediate drop off in redemptions through the spring. It's picked up quite a bit since then, and it's steady but still slow. And so some people that don't have strong balance sheets may not be able to recycle capital. Likewise, they may drop out of wholesale funding lines. And so I think that will determine to some degree what the supply looks like in the market, and similarly how competitors react. So there is a very strong cohort of bridging lenders in the specialist space that I think are well capitalized and well positioned, and I believe we're part of that.
You mentioned earlier as well that you've been busy offering the Siebels bridging product over the past few months. Yeah. How has this been received by the broker community, and how much have you lent through this?
So we've been taken aback somewhat by the level of demand for Siebels. We've used it 100% as a refinancing tool. So our development exit product has been the only accreditation we've had from the British Business Bank, and we actually received £150 million, I think, of applications in the first week since our accreditation, and at the time that was many multiples the size of our initial accreditation allowance. So we have seen a huge need for the product, which is interesting, and maybe more than we expected. I think the broker community have got to grips with the nuances of the product, because there are additional documentation requirements, additional disclosure requirements, which can feel a little bit painful at times, but it is a government scheme, and there are those hoops to jump through. By the end of this year, across our total Siebels and non-Siebels range, we would have done probably about somewhere between 50 and 60 million pounds of new business, which for us, that's about double what we did in 2019. It's not just Siebels, but a fairly significant chunk of that will be Siebels.
Are there any other, obviously you just launched a new bridging product, but are there any other products in the specialist lending market that you will be looking to plug gaps next year?
So across Ultimate Finance as a business as a whole, so we're very active in the invoice finance space, we're very active in the asset finance space, and I think with some of these government lending schemes expiring, cash flow management will be critical for SMEs, and that goes without saying across the board. So I do expect some of those working capital products will be really interesting and particularly strong in the market next year. I mean, clearly within the bridging space, our relaunching this week is residential only. There remains a big gap for financing commercial assets, and as I said before, articulating what we're all about and what we're not is key, and right now we're not financing commercial assets. I think that's partly our heritage. So within the wider Tavistock group that Ultimate Finance are a part of, we've got very substantial investments in commercial real estate, whether that's in the UK or globally, and that covers traditional offices, service offices, retail, hospitality, sports stadiums, you name it, kind of cover the whole market. And so we have a very direct exposure to the commercial real estate market, and definitely understand the challenges, and there are challenges, and it's kind of hard to be one size fits all to say that the commercial market's challenged, but it is. And as a lender, we're not currently comfortable taking a position in the commercial space that we're happy with, or that we could be clear on either internally or externally. But fundamentally, we do like and have liked previously the commercial space. We will look to re-enter that market at some point next year, as I do see a big demand need and a relatively limited supply at the moment. Clearly that could change, but at the moment there's lots of downside pressure on rents, on occupancy, and ultimately valuations.
That's great to hear. I'm sure lots of brokers would be interested to know that you're eyeing the commercial market for next year. There's been a significant gap in that space. You've had a record year of new business this year. Why do you think this is the case? And how has Ultimate adapted during the crisis?
Sure. So we had a very strong first quarter. It was like a long time ago, because it was now, but pre-COVID, we were entering the year with a strong pipeline, and we managed to deliver on a lot of that before the end of March. We never stopped lending through even the peak of the first lockdown in the UK. So that did enable us to keep putting money to work. But Siebels has boosted our balances to quite a degree, I have to say. And so if we hit 60 million by the end of this year, somewhere between a half and 2/3 of that will be Siebels related. And clearly a big part of what any lender does is not just getting money out the door, it's how you work with your clients once they're onboarded. And I think I mentioned before, redemptions were slow, and we had about 8 to 10 million pound of redemptions that were expected in the spring that just stopped and were delayed or cancelled, and that reflects really where the market has been for refinancing. A lot of our back book was on an exit path that involved a refinancing event rather than the sales market, which has been strong in some areas, if not all areas. And so we've had to work doubly hard with our clients this year to support them. And that's really been a joint effort between us and our brokers. So I think never before has the broker lender community come together so strongly to support clients. And I think that needs to be something that maintains through next year and beyond. And what that practically has meant this year is we've been working with our brokers to extend facilities, make sure that clients aren't building up too much LTV risk, staying in touch with everyone on their exit plans and progress alongside that, and just generally showing a lot more understanding to clients than perhaps anyone else would have done in the past. And I think that's been true across a lot of other lenders in the market as well. It's definitely not just us. And I think that's to the credit of the industry that we have rallied around to support clients, because we're nothing without our clients. I think in terms of how we've adapted to this year, and everyone's clearly working from home and has been working from home since the middle of March, and we have got our offices open, but very little demand to go in right now, and I do understand that. But technology has been a big driver for us, and I know we were certainly considering ourselves ahead of the game coming into March in terms of remote working because of our office setup anyway. We were always spread out across the country to be where our brokers and our clients are. So we always had the experience of working and collaborating in a remote environment, so that has been the easy part for us. The harder part is maintaining the engagement internally to make sure spirits are higher, we're looking after staff well-being, and everyone can be at their productive best. But it has also enabled us to probably do things faster and more effectively than we might otherwise have done in terms of intensity and pace. And so we've really invested and doubled down on some of our technology plans, whether that's electronic signing of documents. We've got an ID verification tool that uses facial recognition software. We've launched open banking this year, and actually next week we're launching our broker application portal. So this would absolutely not be replacing the traditional method of personal service, calling a salesperson, sending an email. It's just adding another option and really enabling us to provide as many options as we can to support our brokers. And I think that's where technology will help.